please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to yet another episode of London Eye. My guest today on the show is the Chief Investment Officer of Allianz Global Investors, Lucy Macdonald, who manages $140 billion of equity money across the world, including India. Lucy, thank you very much for joining us on the series today. But let me start by asking you how comfortable you're feeling about equities generally after what has been a fairly volatile start to the year.
We are expecting flatter returns from markets and more volatility. And that's after a period of very strong returns and very low volatility for the last 5 years. And now we think we're in a period where we're going to get just more difficulty in really getting those returns, because we think we're at a peak liquidity as far as the quantitative easing is concerned. We think that corporate profits are now very strong and unlikely to be growing as quickly next year, particularly because we're not going to get the repeat of the US tax benefit. And then from where we're starting, the valuations are quite high, so it's difficult to see a real revaluation upwards for all equities. All of that together suggests to us that returns are going to be flatter, and we think there will be more volatility, a lot of that due to geopolitics.
You allude to almost three P's out there.
Yeah.
Does it mean that the markets and generally the economic conditions are beginning to level off or even slide off a little bit from here?
Well, as far as the corporate profits, which is the most important thing for the equity market, yes, we do think that we will get a deceleration into next year because of that factor in particular of not repeating the US tax reform. However, we're also at quite a high level of margins, particularly in the US as well. So it's difficult to see that you can get much more margin upside, and at a time where you're beginning to see some deceleration in the top line. So overall, that does suggest to us we are seeing a peak in corporate growth at the moment.
But you're not ready to call it the end of the cycle as such in developed markets yet?
Well, it's closer to the end than the beginning. But what is, we think, still going to be a support, and why we think it's not going to be any worse than flat, is that the monetary environment, we think, will still be supportive, and that the reduction in liquidity that we're going to see is going to be affected very carefully by the central banks, and that they will take their time in raising interest rates and in removing the liquidity from the system, because they are still very, very aware of the risks to the system, and they don't want a repeat of the global financial crisis. Now, there is still a lot of debt in the system. That's actually more debt in the system than there was pre-financial crisis. And so it is still a very fragile environment, and all of the central banks really understand that.
So the volatility which has crept in this year, do you think it's a function of the issues that you spoke about, or is it to do with some fear of external risks which seem to be rising around the market?
Well, I think that there are three real reasons for the volatility that we've seen. One is geopolitical, and particularly trade tension, and that's really come to the fore this year, and I think had probably been slightly forgotten towards the end of last year. So that's one thing, and that is a real concern. Second, I think there are a slight inflation upward surprise that really came into the market in February, and that was really as a result of the higher than expected wages in the US, and that was a real concern and a little bit of upward surprise. Everyone's been looking for some wage pressure. No one had ever seen it, for years, and suddenly there appeared to be a bit coming through. Now, whether that is sustained in the rest of the year, we don't know yet. But that was another reason. And the third was just this feeling of higher rates and removal of liquidity. And so those are all reasons, why we think there will continue to be a bit more volatility in the market now than there has been over the last few years. However, for active investors like us, we don't think that's a bad thing. Actually, it's more healthy having more normal levels of volatility in the market, as it is having more normal levels of interest rates. And we've been living in an environment which has been very abnormal, and volatility, you could argue, has been too low, and that risk has not been priced properly. So going into a more normal environment, we think is probably healthier for all concerned, but it is more challenging, and it certainly is more challenging to really deliver the sort of returns that have been delivered in the last few years.
You mentioned active investing, and there's a big debate going on whether active investment actually can deliver alpha over passive investing. Where does the debate stand in the West right now with regard to that?
Well, it depends. And it depends on the asset class that you're looking at. It depends on the environment that you're looking at. And from my perspective as a global investor, it's very clear that it is possible for the average investor to add value in global equities. The median investor outperforms the index over time. So it is an area where there is a possibility of adding alpha. Now, that you can't say the same in all parts of the market, and particularly in US large cap, it's difficult to make that case. However, in the last year, it did do better as a whole. But global is certainly possible, and that's because there's still anomalies around the world, and not all investors are equal in this. So it's indeed possible to do that. However, you can also say it's more challenging than it used to be because there is more competition, and that the alpha generated as a whole is lower than it has been historically. Now, part of that, we think, is also to do with the fact that volatility has been lower, and so that seems to be correlated with this sort of lower alpha generation. However, it is still possible. And certainly, we think we're going into an environment where active investors should be able to do a bit better for two reasons. One is the fact that you are getting now a more differentiation on balance sheets. And so as the liquidity is withdrawn from the market as a whole, those companies which have stronger balance sheets and able to finance themselves should perform better. And therefore, you should have a bigger differentiation. If there's a bigger differentiation, then active managers tend to do better. And the second reason is that we think that there is a huge surge of change going through, which is due to technology. And that's affecting companies very differently. It's affecting, some companies are very much ahead of the curve, and they are investing in the technology and gaining share within their own industries. Others are lagging. And that is also giving a bigger differentiation between performance of companies. And that, again, if you have good research, you're able to differentiate between those winners and losers within each industry. So overall, those factors, we think, are leading to a better environment for active investing, plus at a time when the beta itself is going to be a bit flatter.
You said that we're probably closer to the end of the cycle in the US. But where are we in the cycle with regard to the emerging markets? Because the EM cycle did not quite start when the US cycle started. It may be just 2 years old or 2.5 years old. Do you see EMs actually fleshing out their cycle for a few more years, regardless of whether the US cycle actually ends over the next 1 or 2?
There is more scope. But there's more structural potential, which in the end of the day is more interest to long-term investors. So, we can call, the cycles, but really what we're interested in to see is where is there good long-term structural growth? And there certainly is in the emerging markets. As long as an equity investor, you can find the companies which are able to benefit from that. And that can be companies in those regions, or it can be companies based elsewhere who are benefiting from that growth. And that, in the end of the day, is more interesting than short-term cyclical changes.
How do you look at a market like India in that context? I mean, you run a global portfolio. India is just another market for you. But since you are very stock-specific in your approach, have you in the past been able to spot high-quality companies with great growth potential which have been realized in a market like India?
Yes, and particularly in the technology sector, where there is a very strong domestic and international growth potential, and companies which can compete on a global stage. And that, for us as global investors, is what we're interested in, is seeing where the companies are which have really been supported and have been able to compete. And that is an area where we're still interested. I think what's changing there is for the Indian companies is that the end clients for all of them are demanding higher value-added service, and they are changing the scale of the projects that they are asking for. And that so means that all companies need to be able to provide a lot broader services than they did in the past. So it's not just a question of outsourcing or even consultancy. It's a question of delivering very wide service offerings and digital transformation projects which are taking enterprises and moving them completely into a digital space. And that means having capabilities in cloud, in security, in automation, in all of these areas which the service companies wouldn't traditionally have, but they're going to need to do if they're going to be competing on the world stage.
The other theme which people in India back home are very excited about is the domestic consumption theme. But do you find good companies there as prospects in your investment basket, Indian consumers?
Yes, I mean, our specialists in the area like the jewellery space, and that looks to us to be one which has got quite good demand growth. Even some of the areas which are sort of slightly lower growth are seeing slightly better prospects now in the rural areas, like some of the food companies, which have been a little bit depressed, but that seems to be picking up now. But there's huge potential, structural potential for consumption in India, and it's finding the companies which are both there and externally which are really able to benefit from that.
I come back to those external risks that we spoke about. Some global investors have begun to fret over issues like Argentina, Turkey popping up here and there. Do these have the potential to insert far more risk or volatility into the market, you think, in the foreseeable future?
Yes. I think that the biggest geopolitical issue that, as I mentioned, is trade, because that's the one that can have the biggest impact on overall global GDP. There are many incidents which happen around the world which are very dramatic, or can be very tragic, but they don't necessarily have a big impact on the overall economy. And at the end of the day, when we're investing, that's what we're interested in. So it's trade and any real disruption in trade, which is the big concern at the moment, and seeing how that escalates or not between China and the US, and how other companies get hit in the meantime by that is something that we're focusing on a lot. And one area in particular focus is the technology area, because there are big, long supply chains which go across the world, which can be affected by this. So that's one area we're looking at. Within that context, however, and if that is one of the biggest risks to growth, India looks relatively well placed because it's got such a good domestic focus. And that, I think, from the global investors' point of view and emerging markets investors' point of view, means that they will go to India when they're concerned about some of those big worries globally. So in fact, India can be a relative beneficiary of some of that.
Let me ask you about the US bond deal, because that's consuming a lot of investor attention these days. Do you think most of it is played out in that run up to 3% plus, or is that something which can inject a lot of volatility yet by surprising on the upside? Well,
our expectation is that the path will be slow of interest rates up from here for the reasons that I said. And the inflation picture, as far as we can see it, is relatively muted in the US and elsewhere. However, there is more upside pressure than there's been for a while, and that's both in wages, because of the strength of the corporate sector at the moment, but it's also oil prices, and that shift in oil prices over the year has been quite strong. And that is coming through in some way into input prices. So there is a bit more upward pressure at the moment. However, it's really, when it comes down to what will shift the bond yields, is a combination of that inflation expectations, but it's also supply and demand. And so that's, as we go through the year and we see the increased supply of treasuries coming to the market, that will be a big determinant of where those interest rates or the bond yields go. And for the moment, we think that will be managed. And so if there is a big sell-off, then that program will be adjusted.
If I had to ask you to guess, and it's only a guess because these things are impossible to predict, how far are we away from the next US recession?
Well, we do ask ourselves, this within our strategy group, and at the moment, we can't see it in the next 12 months, and that's really as far as we look when we are doing macro forecasting. So we can't see it at the moment because you've still got an environment which is supportive with monetary policy, less so than it has been, but it is still supportive, and you've got a fiscal boost coming through as well. So we can't see it at the moment.
But does the bull market fade into a bear market synchronously with signs of a recession popping up, or well before it happens? If you're saying it's 12 months away maybe, or more than that.
Could be more.
Could be more. So yeah. When does the bear market kick in? Because most investors worry about the first year of the bear market, which typically takes away 2 or 3 years of gains. You think that would be a couple of years away, or it could now start to get priced in slowly?
Well, the best guess at the moment is that it is really flat rather than either a bull or a bear. And so you can go through an extended period of really not going anywhere, but with more volatility. And at the moment, that looks like our best guess of the environment that we're in. However, it's difficult to see it being better than that, and it's as you go on through time, easier to see it being worse than that. But that's the best guess at the moment.
What's easier to pick right now? A US market which is probably past its peak, or emerging markets adjusted for risk, maybe at a slightly lower end of the growth cycle? In a relative sense, what's easier to make an investment call on?
Well, really what we're looking for is the growth and valuation, and with a quality sort of hurdle. And you can find growth in the US, but it's not cheap. And you can find some value elsewhere, but you need to make sure you're finding growth as well. At the moment, because of the big run-up that you've had in all markets, it's difficult to find both of those things in the same place. And so that's really what we spend all our time looking for. But that valuation angle is definitely more of a challenge now than it was 5 years ago.
Sure. At this stage of the cycle, do PEs tend to compress, or do you get market returns which are more or less in line with the kind of earnings that you're getting?
It's the latter. So at the moment, you would expect you're just holding where you are on PEs, and that's after a period where you have had some compression, particularly because of that US tax reform, which was a major boost to earnings this year. Can't overemphasize how much it is. So you had a sort of 3-point derating in the US market just on the basis of that. So you've had that sort of compression. From now, it looks to us like it's going to be growing in line with those earnings, and then as we go forward, if we do get more upside on the bond yields, then you might see a bit more compression on the Ps.
Does the political landscape look more challenging to you as an investor, or more unpredictable as an investor?
Yes, I think it certainly does, and that is one of the reasons I said why we think we will get some more volatility. Certainly, the advent of Donald Trump as a president of the US has led to more uncertainty about all policy, and so that is something we can't second guess what he's going to do. So we need to just look at the portfolios that we have and the stocks we're looking at to see where the relative exposures might be to that.
What would make you relook at your hypothesis that we are now going to amble through maybe in a period of subpar returns, but it won't be anything drastically bad, or neither is it a roaring bull market? When would you sit and reassess, saying something new has happened and we need to relook at this hypothesis?
I think it's trade. If we really do see a big escalation in tit for tat between the US and China, then I think that would call for reassessment, because it could mean a direct negative impact on growth as a whole, but on some particular sectors like technology, specifically, and because that has been such a big driver of markets and still is, that I think would definitely cause us to reconsider.
And what is your own assessment of whether that risk plays out or not?
It looks certainly a higher risk now than it was 12 months ago, and so it's something that we really do need to be thinking about and taking some action, taking some profits out of some of the highest momentum names that we've got, which are really very exposed to that. So some of the areas where we've been taking some profits out over the last few months have been some areas like semiconductors, which are very much in that sort of line. Plus they are have done very well, and this cycle in some areas is rolling over a bit.
In a phase like this, what is investment strategy that you've chosen? I mean, have you become more defensive in your portfolio positioning just to ride through this kind of period that you just described?
We don't tend to shift the beta of the portfolio around very much, so we don't tend to take too many directional bets in the portfolio. And we're always looking we have a philosophy, we're always looking for growth, we're always looking for quality, and we're always looking for some valuation upside. But in this environment, though, I think that quality threshold, which we always have, is probably going to be just tweaked up a notch. And although over time you can't prove that having a quality focus is a particular benefit to returns, there are times when it certainly helps you avoid disasters. And I think we are going into a time where that quality threshold is going to be more important and will be more beneficial in allowing us to avoid torpedoes.
Lucy, it's been a great pleasure. Thank you very much for your time today.